All right, all right. It is the top of the hour. It's Friday. Those who know, we're going live. We're about to get into this multifamily speech. Bringing the good multifamily gospel today will be none other than me. All right, so glad everybody's here. Hope everybody had a great 4th of July weekend. I know I did. It was a lot of festivities going on. Back into it. So today we'll be hopping into a subject matter that's very important in our market right now, and that's how do you capitalize, right? So you hear these things about wealth being created during economic downturns, and you're supposed to be greedy when there's blood in the streets, and these sort of axioms. But what do you actually do? How do you take advantage of this? So that's what we're going to be digging into today. I want to make this sort of quick. We're going to hop in. We're going to talk about it. I'm going to give you the best that I got so that you can take this information, run with it, go buy apartment complexes, grow your wealth and accelerate, as well as sort of be on the lookout, know how to be cautious in times like this so that you don't get burned. And then we'll sort of open it up for questions like we always do. And we'll be out of here, right? So if you are tuning in, if you have any questions, feel free to go ahead and put those in the comments, and I'll try to take a look at those and make sure that we get those addressed. So with that being said, if you joined in, go ahead and let me know where you are attending this live webinar from, where we reached it to today. And while you all are putting that in the chat, for those who are not familiar with me, let me go ahead and give a few minutes of brief just intro here. So my name is Jason Stubblefield. Been buying apartment complexes since 2016. I'm going to go ahead and do a screen share right now. Hopefully I'm sharing the right thing. I am. So this is my website, realapartments.com. That's RILapartments.com. If you want to know more about me, more about our company, what we're doing, just go to RILapartments.com and it'll let you know. We focus on affordable housing right now. We've got some pretty interesting projects in the pipeline. We're constantly making offers. If you check this out, you can see a little bit about the deals that we've done. And if you are interested in hearing about our investments, there's this Invest Now button right here that'll bring you to this form. You join our investor club. You fill out this brief form, then we'll reach out to you. It'll either be me or it'll be somebody else from our team. And then we'll go ahead and talk about what we're doing to see if it is a match for you. All right. And so that's it. Let's see what we got here today. We got Chuck covered in North Carolina, my man. We got Kentucky in the house. We got Dallas, Texas. All right. Texas been coming in here pretty heavy lately. So let's go ahead. I stopped the screen share. So let me just sort of set the stage, right? How to benefit in the economic downturn. What are some of the signs that we are actually having an economic downturn? Well, news headlines will sort of tell you everything right now, right? We've got high inflation, right? That's happening. Interest rates are on the rise. There's a growing number of foreclosures, talks of a recession. Who knows when they'll actually announce this is a recession, or if there's I stopped paying attention. So if the news is out there, it is. But my reality says that, hey, we're already into a recession right now, but there's recession talk. We've got falling home prices, volatility within the stock market, increased layoffs. All of those are symptoms of an economic downturn. And this happens really as nationwide, right? But it's also going to affect the real estate market. And so when you are in the real estate, what do you do during these times, and how do you protect yourself, right? So let me go ahead and see if I can pull up my whiteboard here, bring this up. It's over. And for those who are attending here, let me know if you all are able to see the whiteboard here. Give me a thumbs up. That comes up. Thumbs up. That comes up. Yep. Okay, cool. So I think I'm good. I think you all can see this here. All right. So we have real estate fundamentals. Okay. And that is one and more, first and foremost, right? It's all about buying off of cash flow. Right. So if you are buying off cash flow, for the most part, you're going to be safe. If you can lock in the interest rate and have a cash flowing asset, you should be okay. Right. You also want to minimize the amount of speculation that you're doing. And so these are the real estate fundamentals. When we get into an economic downturn, what happens is people go away from the real estate fundamentals, right? So instead of buying off cash flow, right, people have been buying off speculation. Speculation like, hey, we don't have cash flow right now, but we'll have cash flow tomorrow. We'll have cash flow after we increase the rents. Or maybe maybe there's very little cash flow, but the property was just purchased based off somebody else being willing to pay more than what they paid. So we'll say we're just going to make $500,000, $1 million in the future. And that's where you get into minimizing your speculation. So we get into economic downturns because people go away from real estate fundamentals. I talked to someone who's out of California that was really looking at buying a fourplex, all for the purpose of no cash flow at all, just being able to sell it to somebody else. So they were going to lose money, right? People do this. They'll buy a property with the expectation to lose money because there's going to be 2 or 3 or 4 or 5, however many hundreds of thousands of dollars that they could potentially make in the future. But when the market shifts, oops, right now you've got a problem, right? So also fundamentals is being a good operator. All right. And so with this, if you do not know how to operate your property, when a downturn comes, you're going to have issues, right? And so what we are right now is we're all in on operations of our assets because it's not as easy to rent units. It's not as easy to deal with turnovers and evictions as it is when the market is good. And the other thing that you do is you don't over leverage, right? This is just basic fundamentals. And so there's a few things that you can utilize to know if you're over leveraging. And one of those is your break even occupancy. And what that is a measure by, you say, how much are my expenses on this property? And then what's the ratio between the vacancy rate and those expenses? So how far can we go down in occupancy to still be able to cover our bills, right? And that's how you know if you're over leveraged. The lower you can get that number, the better you are. But when we get into times where it's a hot market and everyone wants it, people will over leverage, and that break even occupancy number will be too high, right? Lenders do it, buyers do it. And all of that leads into what we have now, which is a downturn in the market. So let me see if I can grab my pen. I want to draw this out for you right now. 1 second. Grab my pen up here. We'll get right to it. So in order to benefit during a time like this, you have to understand real estate markets as a whole. So I'm gonna try to draw this out right now. Let me scroll down and give myself some room. Go this, bam. Bear with me with my drawing here, but we'll make it work. So you got a bell curve of like the real estate cycle. So it sort of goes like this. And then we get this upward thing here and we swing back down there, right? So let me change the colors up. And this will all make sense in a second once I explain this. Let me get my colors here. Let's go with a nice purple. All right. So we've got this section right here, and then we have this section right here, and then we'll have this section right here. And so this is these are the sections of a real estate cycle, right? So over here, we'll call this recovery, right? This first section right here, right? And then over here in this section, this is expansion. All right, let's see if I can fit that in there. Come on, there we go. Look at that. All right, so we got real estate expansion right here. And then this area right here is what some people will call like your hyper supply or oversaturation. Because we're dealing in apartments, apartments are really in need right now. So I wouldn't refer to this as necessarily oversupply, but I would more call it more like a area of stability, right? A stability or balance. And then after that, we have this final section, which is market decline. Call it a decline or recession. All right. So for those who are attending, let's go ahead and take 2 minutes out in the comments. Which one of these areas do y'all think we are in right now? You know, which one of these? Are we in recovery right now? Are we in expansion right now? Stability right now? Decline? Let me explain that so it's fair to everybody. Recovery is usually like we're coming out of a downfall, and so the market is just going up or beginning to go up. Expansion is usually like a hot market, right? And that's when deals are hard to come by. It's a seller's market. Stability is where things sort of even out, and it's for the even out, and then it starts to tilt. And then declining market is where, you know, you got the recession, you got market instability. That so in the comments, what are we going to get as far as where we are in the cycle right now? Let's see. All right. Y'all are shy today. Nobody want you don't want to get it wrong. Okay. I'll go with this. So where we are right now is stability. My opinion. All right. I'm not an economic expert or whatever, but what has happened is with the rising of interest rates, things have really changed, right? So over here in recovery, this is really a buyer's market. All right. This is when it's very great to buy. All right. Over here in expansion phase, this is where you're in a seller's market. You want to be selling property over here, right? This is what I would call balance. And so where I feel we are right now is in balance. What's happened is that we've coming out of a seller's market where we've just been expanding, and multifamily has been trading at lower and lower cap rates. And with the rise in interest rates, the economic downturn, that's not happening as aggressively as it was before. And so now we're in this weird place where buyers are now saying, hey, seller, you got to give me a deal. And sellers are saying, well, I still want to earn on my property like I did. I still want a low cap rate like I would, you know, last year or just a few months ago. So then after that, you get into the decline. And as a decline, it really goes back into a buyer's market, right? So this balancing portion right here is going to weigh itself out over the course of several months or even years until you get to the point where buyers just start walking away. Buyers say, I'm not paying that anymore. After buyers say they're not paying it anymore, then the sellers have to realize, oops, I can't get that money anymore. And because of how they purchased the property, these commercial real estate properties are purchased on terms. So they may get a 3-year term or a 5-year term or something like that. And if that happens, then they have to go to the market. They either have to try to refinance to a higher interest rate, or they have to try to sell the property. And at that point, that's when you get either just buyers or sellers being willing to take a lower asking price, or those who are in financial trouble, they end up having to, you know, the property goes back to the bank, which is when you get into a declining market, which is a good time for you to be able to buy. So understanding what's happening right here is your key to knowing what to do, right? So if we're in the balancing market right now, we're still making offers on properties. We're still actively pursuing properties. But at the same time, we're trying to make sure that we go back up to the real estate fundamentals of making sure that we're buying for cash flow, that we minimize speculation, that we're operating well, and that we do not over leverage. So if you can still find properties like that, then that's fine. And let me say this while I'm at it too. Every market is not the same. So you may be in a buyer's market, in like Atlanta or say, or you may be in a seller's market in California, right? Or depending on what niche of real estate you're in, all of these are not equal. So just because this may happen overall, and when you listen to news headlines, they talk about the overall real estate market, but there is not an overall real estate market. There is a hyper local real estate market that matters to you. So you may be in an area that's still in expansion right now, depending on where you're at. And then you also may be in spots that are already starting to decline. So a good way to know that is calculating the absorption rate, right? And so absorption rate, what that is it's a measure of how many apartment units are available for rent versus how many are actually being consumed. And so that percentage will let you know how hot or cold a market is. And when you start to see absorption rates that are lowering, what that means is that there's more apartments coming available. And what that's going to lead to is a decline in the overall market, a decline in the overall appeal for apartments. You're going to have to lower your rents. You're going to have to maybe start giving some concessions. So absorption rate is really helpful when it comes to trying to figure that out. All right. So right now, I'll sort of take a few minutes just to talk about apartments and why we like apartments. For one, there's just an undersupply of apartments in general, right? So overall, we're millions of apartments shortage nationwide, right? So that leads to a little bit more demand in this particular asset class than there may be in the entire real estate market as a whole, right? And not to mention, you also have affordability problems right now where a lot of people, they're coming out of college or they're early on in their professional careers. And because real estate has gone up so much, they can't buy anything. They simply don't make enough money to buy. So that leads well to there being a need for rentals. And then you got things, baby boomers and people who live the nomad lifestyle who just prefer to rent right now as well. So all those things lead to a lot of just strong fundamentals within the apartment space. However, this scale right here, this bell chart still exists for apartments like they do every asset class. Okay. So then let's get down into what you can do and how you can strategize for yourself when you are buying deals, right? So one is you underwrite conservatively. And what do I mean by that? You're familiar with underwriting? That's the process by looking at the numbers and seeing what your projections are going to look like in the future. What do you think this property is going to do? So you want to be conservative in that. And what does that mean? Well, if you are looking at maybe 5% or 10% rent growth in a market because you're doing a value add strategy, you now want to at least take a hard look at what it looks like if you aren't able to achieve those rents. You may even have some properties that are going to be flat in your rent growth, and you want to make sure that you are conservative of that. So it's not time for you to go in and think, hey, rents are going to continue to go up and up. I mean, last year we had probably a record year when it comes to rental growth. And so that just can't be kept up with, right? So you're going to have a leveling out, if not even a decline, depending on your market. Make sure that you are accounting for that. All right. In your exit cap rates, what we do, what we teach is that you always have an exit cap rate that is higher than where you bought at. Okay, so you're going to assume that the market is going to be worse when you go to sell than it was than when you bought. You always do that. But now you want to sort of play around with these exit cap rates to see if the deal even makes sense. So where you may go up maybe a half a point or even a point in your exit cap rate, now you want to do sensitivity analysis just to see how that looks. And so let me just explain sensitivity analysis. What it is like you're looking at an exit of a property through various scenarios. So what happens if I sell it at a 5 cap? What happens if I sell it at a 6 cap or even a 7 cap? You sort of go down, and what you're looking for here is really sort of like a worst case scenario. And can you be okay with that? Right? Can you be okay if the property doesn't hit all the max rental growth? Can you be okay if it doesn't sell? If interest rates continue to go up, and therefore it puts an increase. It puts upward pressure on cap rates, right? So does the deal still work for you then? All right. Another thing to consider is around here when we get to your loan terms. So this is big, right? Know that commercial real estate is different than residential. In residential, you can get 30 years fixed rate debt, and so you can just hold on to it. In commercial, you're usually lower on your loan term. So you can get low as 3 years, 5 years, 7 years, 10 years and above. So what we like to do right now is we're not only looking at projects that are only looking at loan terms on projects that we can hold 5 or really preferably 7 or more years, right? So we want to be able to weather the storm. And when you do this, it gives you the ability to make decisions. So maybe you buy a property on a 7-year projected hold period. But if you do that and the market, suddenly you hit an expansion phase, right? Well, now you can look to refinance, or you can look to sell, or you can profit within that term. You can always exit a deal faster, right? But what you don't want to do is get into a situation like where you bought on a short-term bridge, and now you're forced to enter the market and sell at a time that it just doesn't make sense, right? And so that gets into a little bit of the balloon terms. You want to make sure that you're preparing yourself for that, right? And that you don't have any short-term balloons, or you're thinking it through. And so that leads into exit strategies. As you're looking at deals right now, you want to have multiple exit strategies. Let's compare this to a bridge loan. If you take out a loan on a short-term debt assumption, right? You've only got a term, say 3 years. 3 years, you need to go back into the market. Well, if the market tanks, or the market continues to tank for that 3-year period, and now you have to go into the market and sell or refinance, that could go bad for you. So you may think about buying a project that way, but then you also want to consider, well, maybe we need to do something long term, right? And maybe we can get it to hold. And you also want to think about, maybe we can refinance. And does your business plan allow you to have multiple exit strategies of that deal, right? Could you refinance it? Could you structure the financing in a different way? Could you sell the property? All of those things you want to consider, so that you're not going into a deal and without any flexibility over, right? If you would do these things though, right, and you still look right now within the market cycles, if you buy for a cash flow and you structure your loan terms where you have long-term debt, you have multiple exit strategies, well, now you get the benefit. And so at the beginning of this, we discussed about how people make a lot of money in this business, and it happens by being able to purchase here and here, right? And also even here, right? So you can do well, but what you don't want to be is the person who buys here during the great expansion period, and now you got to come out and sell into either a balanced market, or even worse, a declining market over here, because now you're not going to do well. Knowing this information though, that's how you capitalize. Say, all right, now I'm balanced. Now I want to make sure I've got long-term debt that I can put on a property that's going to cash flow, and I can ride this out, right? You want to be able to ride this cycle out, even throughout here, all the way up to here. And the way you do that is you have more money coming in when you buy the property than you do when you exit the property, right? Well, you have enough money coming in so that there's cash flow there, so that you don't necessarily have to care what happens with interest rates. You don't have to care what happens when it's a buyer's market or seller's market. You got cash flow and long-term debts you can hold until the market recovers and you get to a place that's optimal for you to sell. So, all right. Let's see if we got any questions about that. Let's see. I'll go ahead and stop the screen share now. Let me X that out. Boom. Okay. So questions that we got. D, like, what's the best way to figure out absorption rate in non-disclosure states? So A non-disclosure state is really about taxes. It's not necessarily about absorption rate. The absorption rates is there. You can figure that out. There's a few ways. We leverage CoStar reports. And so CoStar's got a great way of doing it. If you just Google like wherever your market is, if it's Dallas or whatever, absorption rate, you'll find articles. So some articles like Cushman and Wakefield or Marcus and Millichap, they do these surveys. And so they'll put that out just telling you what the absorption rate is for the last quarter or the last 6 months or even the last year. And so you can figure that out. What you want to do is have the ability to watch it and monitor it just to know when it's sort of slowing down. Like now, these units aren't being absorbed as quickly as possible. So that may lead you to say, this is not the time for me to invest in this market right now. So hopefully that answers your question. Yep, and I think that's it. We don't have any other questions that we will wrap it up. Key takeaways is just to understand that this is an opportunity time right now. So if you can understand commercial real estate, if you can understand how to buy apartments right now and be able to do it, your future looks very bright in the next 3, 5, 6 years, however it looks, right? So be smart, be careful. I'm here to try to help y'all out however we can, and I'm doing the same thing in my business. So that's it for today. We will wrap this thing up right here at 11:30. Hope y'all have a great weekend. Make it a great day on purpose and be the best version of you, because it'll make you the happiest. I'll see y'all later. Take care.